Imagine you just got a job offer in Ireland and you're wondering how much tax you'll have to pay. Or maybe you're already living and working in Ireland and you want to understand how your income tax is calculated. Either way, you need to know some basic facts about personal taxation in Ireland. Did you know that Ireland's tax system has not one, not two, but four tax brackets? Depending on your earnings, you could be taxed at 20% or 40%. And don't forget the Universal Social Charge, USC, and pay-related social insurance, PRSI. There are two rates of income tax, 20% and 40%. The first part of your income, up to a certain amount, is taxed at 20%. This is known as the standard rate of tax, and the amount that it applies to is known as the standard rate tax band. The remainder of your income is taxed at the higher rate of 20%. The standard rate tax band depends on your marital status and income source. For single people, the standard rate tax band is €40,000 per year. For married couples, it depends on whether one or both spouses are working. If only one spouse works, the standard rate tax band is €44,300. If both spouses work, the standard rate tax band is €80,000, but it cannot exceed €44,300 for any one spouse. If you're self-employed, you're dancing to a slightly different tune. Don't forget about the joy of preliminary tax, pay in advance or feel the burn during the tax season. You might be eligible for various tax credits and reliefs. Tax credits reduce the amount of tax you have to pay by giving you a credit for certain expenses or circumstances. For example, you might get a personal tax credit of €1,775 if you're single, or €3,550 if you're married. You might also get tax credits for paying rent, mortgage interest, medical expenses, tuition fees. The Citizens Information Board explains that tax credits like the home carer tax credit can significantly benefit those caring for a dependent person. Tax relief reduces your taxable income by allowing you to deduct certain expenses from your gross income. For example, you might get tax relief for contributing to a pension scheme, donating to charity, investing in a startup company, and else. You can file your tax return online or by paper. If you are an employee, your employer will deduct income tax, USC and PRSI from your salary and pay them to revenue on your behalf. This is known as pay as you earn, PAYE. You will receive a payslip from your employer showing how much tax you have paid. You can also check your tax record online using Revenue's My Account services. If you are self-employed or have other sources of income, you have to file a self-assessment tax return every year. You can do this online using Revenue's online service, ROS, or by paper using Form 112. Imagine you're a foreigner who has moved to Ireland for work or retirement and you have income or assets abroad. You will be taxed on your foreign income or gains. Will you have to pay tax on everything you earn or own, or only on what you bring in? The remittance basis of taxation has some exceptions and limitations. There are some types of foreign income and gains that are always taxable in Ireland, regardless of whether you remit them or not. These include income from an employment that is exercised in Ireland, income for the trade or profession that is carried on in Ireland, and gains from the disposal of Irish land or property. There are also some anti-avoidance rules that might prevent you from using the remittance basis of taxation if you try to shelter your foreign income or gains in offshore trusts, companies, or bank accounts. The remittance basis of taxation might have implications for your social security contributions. If you claim the remittance basis of taxation, you might not have to pay pay-related social insurance, PRSI, on your foreign income or gains unless they are from an employment that is exercised in Ireland or a trade or profession that is carried on in Ireland. However, this might affect your entitlement to social welfare benefits in Ireland, such as pensions, maternity benefits, illness benefits. You might also have to pay social security contributions in your country of origin or residence, depending on the tax treaty between Ireland and that country. The remittance basis of taxation might have advantages and disadvantages for you. The main advantage of the remittance basis of taxation is that it can reduce your tax liability in Ireland by allowing you to keep your foreign income and gains outside of Ireland without paying tax on them. This can help you fund your expenses in Ireland tax efficiently, especially if you have income or gains from before you move to Ireland, which can be brought into Ireland tax-free. The main disadvantage of the remittance basis of taxation is that it can complicate your tax affairs by requiring you to keep track of your foreign income and gains, and any advance that you remit to Ireland. It can also limit your access to social welfare benefits in Ireland by reducing your PRSI contributions. Make sure to file your tax return by October 31st online or mid-November by paper. There you have it. Of course, this is not an exhaustive list and there might be other factors that affect your tax situation. If you need more information or advice, you can contact Revenue or consult a professional tax advisor. That's it for this video. I hope you find it helpful, and if you have any question, be sure to leave a comment below. And don't forget to subscribe to my channel for more videos like this one.